Hey everybody, welcome to this week's weekly Thrive in China roundtable, where we are going to be discussing profit repatriation strategies and outbound payments from China. For those of you that are new to the roundtable concept, how the roundtable works is that we're here to educate you on the topic of the week. If you've got any questions surrounding this topic or in general about doing business in China, don't hesitate to reach out. This is your time spent, whether you're watching this live or watching this on replay. Use it wisely and feel free to ask. I will be setting up a WeChat group so that we can also put the questions that are popping in into the WeChat group, and we can extend then that conversation through WeChat. We're using Zoom. If you run into any technical difficulties, my suggestion is just to pop back in using the URL that you've got. If that doesn't work, just watch the recording once I send you the link to the recording. Allow me to just briefly introduce myself. My name is Kristina Koehler-Coluccia. I'm the head of business advisory at Woodburn Accountants and Advisors. I'm a leading expert on inbound investment into China, and I've got over 17 years of on-the-ground experience in corporate services and corporate compliance. We have worked with over 500 companies on their expansion into the Hong Kong and Chinese market, helping them in all phases of their journey, all the way from the beginning of market research, trademark registrations, all the way through to actual implementation of entities, sharing our ecosystem so that companies can actually meet and greet distributors, TPs, logistics companies, media agencies, PR agencies, whatever would be needed to support and scale up the business. Ultimately, how we help our clients is to really look at the finances surrounding the company. We consider ourselves as acting as your outsourced finance team, from being your CFO all the way down to your cashier. And of course, in my opinion, you can't really scale up your business in China unless you understand your numbers. So if any of this hits a nerve on you and you want to talk more about our services and what we can offer, don't hesitate to reach out. Also, I wrote a book during COVID on the 10 biggest mistakes companies make in China. This is a summary of the mistakes I've made in China, as well as those that I've seen happen to either friends or clients as well. It's a fun, interesting read, and if you'd like to have a copy, don't hesitate to ask. You can email me at Kristina@woodburnglobal.com. So the topic for today is around developing profit repatriation strategies in China and processing outbound payments from China. What we're covering today is the common concerns. We're going to look at the methodologies, and we're also going to talk about bank processes, tax processes, and obviously suspicious signs for evasion and tips to get the strategies properly set up. So common concerns from companies in China or from foreign investors is foreign exchange risk in terms of getting money out. It's the political risk. Will China actually not allow us to do it? There's the capital market risks, and then there's the procedural complexities. And by this, I'm referring to the tax bureau and the bank, which can be the obstacles in terms of getting the money out. All right, so we're going to touch a little bit on all of these things. Just very briefly, from a foreign exchange risk perspective, there is a solution where you can actually repatriate in renminbi to a renminbi overseas account. From a political risk, China will never say that you cannot bring your money out. You just have to make sure that it's legitimate the way that you are doing it, and that you're going through the regular processes and methodologies to do it. And you've got the supporting documentation to actually prove what you're doing. And then from a procedural complexity standpoint, it's a procedure. You got to abide by it. And if you don't provide the right documentation to support the transaction, then don't be surprised when they say no. But we'll go through this in more detail today. So why are profit repatriation strategies important for your China business? Well, they're basically, I've seen this all the way from 2008, 2009, when overseas companies were suffering that they didn't have enough cash in their business. China was doing so wonderfully, and they needed to be able to free up capital for their overseas investments. So it does aid in repatriating funds to free up the use of this capital for other investments. It aids in developing a tax optimized structure where you are doing tax planning, understanding when you're going to become profitable. It guides you in developing true, authentic agreements so that the business is legitimate and that you know exactly at one point profits are going to be repatriated. It also guides you in giving you a choice because you don't have to repatriate if you don't want to. And especially for entrepreneurs, this is a big thing because their goal is always, I got to take my money out. It's not. If you're planning to further invest into the market, then you may want to keep your money in China for that further investment, right? So do keep that in mind. Why is it important to understand how to repatriate funds overseas? Very simply, 4 things. It helps in understanding China processes. My husband always likes to repeat to me, processes and methodologies is a key to survive in China, which basically means that everything is possible in China, but nothing is easy because you have to go through these processes and methodologies, which after 18 years are not complex anymore for me, but I can understand that the amount of paperwork may overwhelm people in truly understanding how it all works. It helps in your communication abilities with your Chinese counterparts. And for me, this is a big one because there's always a communication bridge between head office China or a communication bridge between clients in China and service providers globally. If you can understand how the outbound payment process works, perhaps you wouldn't be putting so much pressure on your Chinese counterparts to get the money out because they are struggling. It is a struggle. It is an application procedure. It's not that it happens overnight through an online banking transfer. There are documents that have to be submitted. There are stages of development you have to go through, and you have to understand what those are and how much man labor is actually required to fulfill a payment. It also helps in preventing you from being cheated by your Chinese counterparts, particularly on the tax component, because if you are doing outbound payments and you are a service provider overseas and you've got Chinese clients and they're telling you, well, you know, you've asked for 10,000 pounds net, but actually you didn't take into consideration all of the taxes and there's going to be a 20% deduction. Well, it's not going to be 20% and you'll see why it's not. So understanding what the tax rates are going to be applicable is important so that you have the leverage to negotiate and answer back, hey, look, you've requested the service from an overseas company. You are liable for the taxes, not me. I want net 10,000. Taxes come from out of your pocket. And by the way, it's not 20%. I know that it is 5 plus 6 or 5 plus 3, depending on your tax status. If you can answer back like that, right, you have the leverage to negotiate and be able to get your money quicker. It also helps you to get organized, knowing how to formulate your contracts, what to look at in your contracts, and make sure that all supporting documentation is readily available. So first of all, very briefly, I just want to give an idea on the concept of taxes in China. Are the authorities in China familiar with tax optimized structures? Yes, they are. All right. They're fully aware of tax havens. They are fully aware of people trying to get their money out in order to pay less profits tax. They're fully aware of all these things, which is why the process has become more complex and the paperwork involved has also increased. Now, when you're dealing, I always say there are 2 principles in my mind. 1, we don't mess around with the Labor Bureau, and 2, we don't mess around with the Tax Bureau. So we want to make sure that we are a legitimate business. We don't have fake contracts. We have true and valid agreements that truly reflect the transactions that are going through the company. We want to be smart. We will not fool the tax authorities in China. We don't want to mess with them. We don't want to get into complicated situations. So let's not fake anything, and let's avoid tax evasion. Okay, again, I want to go back to the word of tax optimization. We also need to make sure that whoever you are transferring, whoever the Chinese company is transferring money to, is not a holding company, because you won't benefit from any of the tax rates, which is again part of that tax negotiation that you might have with your clients in China, with your subsidiary in China. If that overseas company has no economic or commercial substance and you can't prove it, you will run into difficulties and pay more taxes on this outbound transfer. And then you've got to understand where I said earlier, one of the concerns is foreign exchange risks, well, there's also another bigger concern, which is the lack of Forex in China, which is why if you've got high value transactions, it might not be overnight that you get the payment done, because the company in China needs to apply for the Forex, which could take up to 6 weeks, depending again on how big that value is. So you need to be aware of this, which is why I want to offer you the solution of thinking about opening up a renminbi account overseas so that you can invoice in renminbi. Chinese company pays in renminbi, so they're not waiting around for any form of Forex, and it does make the process go faster. The basic procedural steps for profit repatriation in China. Now, this conversation is obviously geared to those of you that have subsidiaries in China. But for those of you that are on here today to understand the outbound payment processes, you can ignore all of this. Focus on the processes that I'll be going through based on these different profit repatriation strategies, because that will give you the insight on the problems that the Chinese companies are facing. So the first thing is that profits tax, corporate income tax, enterprise income tax, this is all unified at a 25% rate, but there are exceptions for SMEs. There are exceptions for high-tech companies. There are exceptions depending on certain locations where you might have registered your company. There might be exceptions if you're in clean tech, etc. Right? Now, but before distributing after-tax profits, the foreign invested company in China, the Chinese company, is required to make up any losses carried forward from previous years. And you can carry forward losses up to 5 years. In 2020, for that year, it's carried forward for up to 6 years. In addition to that, you will have to allocate a certain rate of after-tax profit into a reserve fund, enterprise development fund, or a staff incentive and welfare fund if you've got all three. But at a minimum, you will always have a reserve fund, and this does need to be allocated into the fund. And these reserve funds, all of these funds are actually buffers, if you will, that are utilized in case of bankruptcy. So as I said, the reserve funds, enterprise development funds, and staff incentive and welfare funds are basically funds that are there to protect the business in case of going into bankruptcy. You always allocate a certain amount of money into these funds. At a minimum, you will have the reserve funds, and it is capped at 50% of your registered capital. Okay, but you do have to allocate it within before you can do any form of dividend repatriation. When you are doing any outbound payments, and this is particularly advice for if you're doing that between sister companies, is looking at the transfer pricing regulations in China. Now, you only have to create a local file should you meet any of these 4 criteria. And I've highlighted particularly the last one in red, because this is where most people would fall in and trigger transfer pricing regulations. So if there are any sister related party transactions that exceed 40 million renminbi in a fiscal year, then you need to start preparing your local file in order to then justify your transfer pricing regulations that are occurring. That would be your trigger. Obviously, if there are transactions that exceed over 200 renminbi for tangible goods, or financial asset transactions exceeding 100 million renminbi, intangible assets over 100 million renminbi, those are also triggers. But most commonly, I am seeing these sister-related transactions of up to 40 million. So that means you need to have a transfer pricing regulation in mind, and a margin should be kept in China. The next thing you need to be looking at before you do any sort of repatriation strategy is the double taxation agreements between China and whatever country you're remitting to. I've put in the example today of the United Kingdom, but could be to the US, could be to Luxembourg, could be to Germany, could be to Hong Kong, could be to Australia. So you've got to look at these double taxation agreements. For me, the most important column that you've got to look at is the last one, which is the latest DTA, double taxation agreement rates between China and the UK. And what you will find is that for dividend repatriation, you're looking at a dividends tax or withholding tax on dividends of 5%. For interest and royalties and service fees, you're looking at between 6 and 10%. and capital gains is also at 10%. Okay. Now, before I get into this, now again, this portion is really geared to those of you that have subsidiaries in China and are thinking about profit repatriation strategies. For those of you that have come on here today to look at what the outbound transfer process looks like, I will be explaining that with each of these methodologies so you have an understanding. But before we start any of that, what I want to highlight is, and I highlighted this actually in a webinar I did yesterday for our LinkedIn challenge, is tax planning. There's no point in getting excited by preferential tax rates or by any of that without knowing when you are going to actually be profitable in China. Okay, so are you going to be profitable in 5 years? How are you going to use the money that you make? Do you need to keep the money that you make in order for further investments or to, to pay for increased headcount, marketing initiatives, whatever? You've got to now create simulations and scenarios on when you're starting to be profitable, when taxes will actually be implemented, etc. And then when can the strategies begin? All right. I say this because it won't happen overnight. The rule of thumb I can say is that it will take between 3 to 5 years until you break even. Obviously, there are always exceptions, but in general, it will take 3 to 5 years to break even, at which point then you might be making a little bit of money year on year. And so I do want you to weigh into this. I do highlight that these strategies should be implemented as soon as possible, just so that you've got them set up, remembering that it's flexible and can always be amended. So the methods of repatriation, number one, simplest method is dividend repatriation, okay? What you just need to keep in mind is that the after-tax profit can only be repatriated if all of the registered capital has been injected. Although I will say during COVID times, we have actually seen with several companies that even though the registered capital has not been fully injected, the business is so profitable that by just putting in a couple thousand US dollars in registered capital, you can actually repatriate the funds. It's just a matter of a shareholders resolution being signed off to be able to initiate that. The prior year's losses have to have been made up, and the statutory reserve funds have to be allocated. Okay, so those three things have to happen. Tax considerations. When you're doing dividend repatriation, right? Obviously, you've declared your profits tax, which is whatever it is, depending on your situation. And then if you're repatriating to the UK, Hong Kong, Germany, France, Belgium, Luxembourg, almost a lot of countries, the withholding tax will be at 5%, okay? Again, depending on the amount you're going to be transferring as dividends, they will be checking the economic and commercial substance of that UK company so that you can truly benefit from this DTA rate versus then going to the original rate, which is 20%. Now, here's the outbound payment process. The first step is the approval from the tax bureau. So when you go to the tax bureau and you say, I want to do a dividend transfer, they want to see the annual audit completed, and they want to see that the annual profits tax filing has also been completed. They want a resolution signed by the shareholders that profits should be distributed and at what value. Then we need to apply for the DTA benefits, right? So if we're repatriating to the UK, we want to apply for the 5% withholding tax rate on dividends. Like I said earlier, filing of the profits tax return, annual profits tax return should also have been completed, depending on the value. So normally, if you are repatriating the equivalent of 50,000 US dollars, you can just do it. There's no approval process on that. However, if it's more than 50,000, the equivalent of 50,000 US dollar in whatever currency, you will have to do a record filing with the tax bureau, which is then combined with the State Administration of Foreign Exchange. Okay. And then goes to the bank payment. Okay, but you need all of these documents and all of this procedure to go to your tax bureau and say, now we want to distribute dividends. The next step after that is the bank payment. Okay. So once you've got approval from the tax bureau and they've chopped and signed saying, yes, the 5% has been paid, we're happy, you go to the bank, you fill out an application form. You also need to provide original of the signed resolution. You also have to provide the audit reports. the tax record filing form that you've done your annual profits tax filing, and proof that the registered capital has been paid and the reserve funds have been allocated. This can usually be seen within the audit reports, but sometimes they ask for additional shareholder signings specifically on that. So you can see the amount of documents that have to be prepared for these types of transactions. And it's not just preparing the documents and saying, here, okay, and they look at it within 24 hours and accept. No, the tax bureau could take weeks to review your documents. The bank could take weeks to review your documents and then come back and ask for more. So this whole process could take anywhere between 4 to 6 weeks to initiate. The second methodology is around service fees. Okay, so again, we're trying to create true and valid business reasons for implementing the service fees. I'm going to make up an example now. Let's say there's a marketing agreement, which basically means that I'll use the UK as an example. The UK company is doing marketing initiatives on behalf of the China organization, and they are paying bills that are related to marketing initiatives on behalf of the Chinese company. Well, in theory, China should be reimbursing the UK for these payments. And ideally, there would be an agreement with the appendices showing the invoices that can then be taken to the tax bureau. And potentially, the UK should have a margin, according to transfer pricing regulations, on the service that they're actually offering, which is a marketing service. Then you've got management service agreements where you will have people in your head office that are in charge of the China business or are spending 50% of the time on the China business. And as a consequence, China has to pay for their time spent. It's not that they're paying salaries, it's that they're paying for their time spent to the head office. And it could be an hourly rate, it could be a percentage on revenue, it could be whatever. In previous times, they would normally accept man-day rates and then always check the entry-exit visas to also see that people were traveling to China, because you would also ask for reimbursements for hotel costs, transport costs, and they would want to see all of these receipts as well. There could also be technical service agreements where you have engineers that are sitting abroad that can only do the implementation of machinery or training or whatever else. And again, China has to pay for those fees. So again, remember, these are thinking of ways of getting your money out, but they have to be true and authentic agreements. There actually has to be this work being performed in the head office. When you're formulating these agreements, remember to think about transfer pricing. Remember that the contracts from a Chinese perspective need to at least be in Chinese. We always recommend them to be bilingual. And then you also have to think about permanent establishment guidelines. So if you've got management services or technical services and people, it's not happening now, but people are traveling to China, you do have to think about permanent establishment guidelines that would be written in the double taxation agreement as well. So with the UK, it's 183 day in a fiscal year timeline before permanent establishment would be initiated. Then you've got to look at tax considerations. So in this situation, for those types of agreements, VAT cannot be refunded or exempted. That would only be in special circumstances. But the question is who will pay for all the taxes upon repatriation? Ultimately, it's the Chinese company that needs to pay it, all right? Not the UK company. The Chinese company is liable. From a VAT perspective, you have to look at the status of the Chinese company. Are they a small scale taxpayer or a general VAT taxpayer? And then you also have to look at the double taxation agreement in terms of what the rate would be. For service fees, it's generally at 10%. So outbound pay, hold on. And this is just for those of you that are on here watching for the outbound payment process and how that actually works. So you would be looking at generally a 10% withholding tax on the transfer out, plus a 6.8 or 3.5%. So you're looking at a 16.8 or 13.5% range. Could be that some people say 6.75 as a VAT. Some people might say a 3.2% as a VAT and surtax, because the surtax is always a variable. In terms of the outbound payment process, approval process is at the tax bureau. When you have the contract formulated and signed, this contract has to be registered with the tax bureau. So again, for those of you that are on here looking at outbound payment processes, right? The client in China, the customer in China, the company in China needs to take your contract, which is why there has to be a contract, to the tax bureau and get it registered, which can take anywhere between 2 to 6 weeks. That's number one. Then you are applying for the DTA benefits. So the companies in China should be applying for that at the point of the contract registration. Then they have to show that they have filed the taxes, so the withholding tax plus the VAT and surtax. Then if the amount of the invoice is higher than 50,000 US dollars, they have to do a record filing with the tax bureau, and then they go to the bank. And with all of this, there needs to be a chop on the contract to stipulate ultimately that the tax bureau has approved it. Then you go to the bank with the approval from the tax bureau. You also provide the service contract to the bank. You can provide the payment notice or invoice and any other documents that the bank may request in order to prove authenticity and the true value of the transaction. They're also going to do their check because, again, they want to avoid any form of money laundering. And they may ask for further documentation. They also may ask that application forms have to be filled in that are generated from the bank as well. All of this stuff is done at the bank. This is not online banking, guys. This is actual approvals, document swaps at the bank. Methodology 3 is looking at royalty fees. So it's looking at technology transfer agreements, trademark licensing agreements, etc. And it's a very similar concept as the service fee concept, right? You have to look at the transfer pricing model. Contracts need to be in English and Chinese. Chinese is a must, but English is what we recommend. They have to be true. For me, trademark licensing agreements are the easiest because my assumption is you've registered your trademark in China. If you haven't, that should be on your priority list. You take your trademark certificate, and obviously you're invoicing the owner of the trademark, right? That has to be clear. Again, tax considerations is that there's going to be, with the UK, a 6% withholding tax. There's going to be VAT. Depending on the type of agreement, the VAT may be refunded or exempted. The outbound payment process is exactly the same as I've mentioned before. Contract registration is key, first step. Then you want to apply for the DTA benefits. You want to show that all the taxes have been paid, which will come from the tax bureau. If the amount is over 50,000 US dollars, you're going to have to do also a record filing with the tax bureau, and then you can go to the bank. And at the bank, you'll have an application form. You'll have to show the contract. So this is for trademark. I put here an example for trademark payments, so licensing invoices. You're going to have to show the business license, the registration certificate of the parent company who owns the trademark, how the commission fee has been calculated to use those brand assets. They may have to show the latest audit reports, and then they'll have to show the certificate of trademark registration or patent license or copyright license. Hefty work, right? So those are basically the 3 repatriation types of methodologies, right? Dividend repatriation, service fee repatriation, and then you've got royalty fee repatriation. There are other methods of repatriation, but they're not as common as they used to be in the past. One is capital reduction, which is not really a form of repatriation. It's just that you want to lower your registered capital value. It could be that you're acquiring assets overseas in the name of a Chinese company. This did happen a lot in 2008, 2009. It's happening less and less, especially by foreign invested companies in China. Could very well be that you want your Chinese company to have an offshore loan, to offer an offshore loan to the overseas shareholder. Could be that there's an adjustment in your pricing model, but then you have to show your local file for your transfer pricing processes and methodologies, and any other offshore investments that actually might be made. Suspicious signs for evasion by the tax authorities. These are things that you've got to keep in mind when you're thinking about developing profit repatriation strategies. And again, this is really geared absolutely to companies that have subsidiaries in China. The first is significant amounts or numerous types of related party transactions. If there are too many sister related company transactions, this is a red flag. If you've had long-term losses of low profitability or loss, or fluctuating patterns of profit and loss, this will also be a red flag, because at some point they want to see stability and growth in China, as should you. And therefore you have to be careful with how you're going to be repatriating the funds, and then also looking at the contracts from time to time. If you have below average profitability for your industry, then you might be red flagged. And this is part of the golden tax system. Business dealings with companies that are established in tax havens will always be a red flag. If you've got absent or incomplete transfer pricing documentation, so you've got to prepare yourself for that. And if there are any violations of the arm's length principle when they look at the transfer pricing documentation. So these are the red flags. And here are some tips. We want to create true, authentic agreements and contracts. And before I even begin on that, we want to make sure we have agreements and contracts, and not verbal agreements or email agreements. That doesn't work. We want actual contracts that are readily available in there. We want to be smart and choose our battles with the tax bureaus, with the bank, with the government bureaus. We don't want to fight every single dispute. So be wary on trying to make everything as legitimate as possible, so that you are not in constant war with the tax bureau or the bank. Make sure you conduct the contract registrations for these repatriation strategies as soon as possible. For those of you that are on here looking at outbound payment processes, make sure there's a contract with your clients in China, and maybe be proactive and ask them, saying, I'm familiar with how this works in China. I think you should be registering our contracts with the tax bureaus. And make sure you get your contract registration number from the tax officer as well. Apply to the tax authority for the tax assessment during the contract registration. Apply for the treaty benefits during the contract registration as well. And understand the document requirements from both parties, tax bureau and bank, ahead of time. Get a list from them. Verify that list a week later, verify it again a third time a week after that, to make sure you have the full document list. You might even find that a bank teller gives you a different list from another bank teller. So make sure you verify this 2-3 times. That's the end of today's roundtable on profit repatriation. I hope that's helped some of you. And if it has triggered anything in some of you in terms of wanting to create profit repatriation strategies, or for those of you that are doing looking at outbound, having Chinese clients who are doing outbound payments to you, and you want clarity or specific to your case, don't hesitate to reach out and ask me on that. How can you work with me? We offer incorporation advisory, incorporation implementation in China. We do competitor benchmarking, appointments of various roles within the corporate structures. We offer tax advisory and also outsourcing solutions as CFOs and finance people within companies in China. So just a bit of background on us. And I want to thank you for joining this week's Thrive in China Roundtable. Again, just to highlight what's coming up next. Next week, we're talking about how to start your business with your China accountant, how to write a business plan for China, 6 ways to do business in China without setting up an office or entity, how to vet your potential business partners in China, and how to register your trademark. And then we will be starting in June a whole series on marketing, branding, distribution business models, logistics, etc. So I hope that will be exciting for you all. I look forward to seeing you all next week. Take care and goodbye.